Hey there, I want to talk to you about something that's going to impact millions of retirees, and it's coming faster than most people realize. If you're retired close to retirement, or even just thinking about your financial future, this is something you absolutely need to hear. And trust me, it's not just another financial headline. This is a real tangible shift that could change the way you live out your retirement years. Now, I know taxes aren't exactly the most exciting topic to dive into, but here's the thing. The tax laws we've been living under for the past several years are about to change in a big way. And when I say big, I mean it could cost retirees tens, even hundreds of thousands of dollars over the course of their retirement. That's not an exaggeration, it's a reality that's coming in 2026. And the worst part, most people don't even know it's happening. Let me break it down for you. Back in 2017, Congress passed the Tax Cuts and Jobs Act, or TCJA for short. You might remember it. It was a big deal at the time. It lowered tax brackets, raised the standard deduction, and even increased the estate tax exemption. For retirees, it was a bit of a financial breather. Lower taxes meant more money in your pocket, and for many, it made retirement a little more comfortable. But here's the catch. Those changes weren't permanent. They were designed to expire at the end of 2025, and when they do, the tax rules will revert to what they were before 2017, only adjusted for inflation. That means higher tax brackets, lower deductions, and a much smaller estate tax exemption. It's like the financial rug is being pulled out from under retirees, and unless Congress steps in to extend those provisions, we're all going to feel it. Now, I know what you might be thinking. Well, Congress will probably do something about it, right? They won't just let taxes go up for everyone. And I get that optimism, but here's the reality. Betting on Congress to act quickly and decisively is a gamble. Historically, major tax decisions don't happen overnight. They're slow, they're partisan, and they're often delayed until the very last minute, if they happen at all. So waiting around and hoping for a political solution, that's not a strategy, it's a risk. And it's one that could cost you dearly. Let's talk about what's actually going to happen in 2026 if nothing changes. First, income tax brackets are going to increase across the board. For example, the 12% bracket will jump to 15%. And the 22% bracket will rise to 20%. That might not sound like a huge difference, but here's the kicker. More of your income will get pushed into those higher brackets. It's called bracket creep, and it means you'll end up paying more in taxes even if your income doesn't change. And for retirees, who are often on fixed or semi-fixed incomes, that's a big deal. Then there's the standard deduction. Right now it's pretty generous, especially for married couples filing jointly. But in 2026, it's going to drop significantly. That means more of your income will be taxable, which again means higher taxes. And if you're someone who relies on Social Security, pensions, or required minimum distributions, RMDs from your retirement accounts, this is going to hit you hard. Your income stays the same, but your tax bill goes up. It's a double whammy that reduces your spending power and makes it harder to enjoy the retirement you've worked so hard for. And we haven't even gotten to the estate tax yet. Right now, the state tax exemption is around $13.6 million per person, or about 27 million for a married couple. That's a pretty high threshold, and for most families, it means they don't have to worry about estate taxes. But in 2026, that exemption is going to be cut in half. Suddenly, estates worth more than 7 million per person, or 14 million per couple, will be subject to a 40% federal estate tax. And remember, your estate includes everything: your home, your retirement accounts, your life insurance payouts, your investments, even your family business or farm. For families who fall above that threshold, the tax bill could be devastating. Heirs might have to sell off assets just to pay the tax, which Warren Buffett has called wealth destruction, not wealth transfer. So why are retirees hit the hardest by all of this? It comes down to a few key factors. First, most retirees are living on fixed or semi-fixed incomes. Social Security, pensions, and RMDs don't adjust for tax hikes. Your income stays the same, but your taxes go up, which means you have less money to cover your expenses. Over time, that can really add up. Then there's the issue of RMDs. If you have a traditional IRA or 401k, you're required to start taking minimum distributions once you hit age 73. Those distributions are taxable, and after 2026, they'll be taxed at higher rates over the course of 20 or 30 years. That could cost you hundreds of thousands of dollars in additional taxes. And it's not just the RMDs themselves that are the problem. They can also push you into higher tax brackets, which means you'll pay more on all of your income, not just the RMDs. And let's not forget about Social Security. Did you know that your Social Security benefits can become taxable? It's based on something called provisional income, which includes your RMDs, your pension, and half of your Social Security benefits. If your provisional income exceeds certain thresholds, up to 85% of your Social Security benefits can become taxable. And here's the kicker: higher RMDs push you over those thresholds, which means you end up paying taxes on your Social Security benefits too. It's a compounding tax trap that leaves you with less net income and fewer options. This is a serious situation, a triple threat that squeezes retirees from all sides: higher income tax rates, a lower standard deduction, and the taxation of Social Security benefits, all combined to eat away at your retirement savings. It's a slow motion crisis that many won't notice until their bank accounts start to shrink, and by then it might be too late to do anything about it. Let's circle back to the estate tax for a moment, because this is an area where the changes are particularly stark and the consequences can be devastating for your family. As I mentioned, the current exemption is historically high, sitting at about $13.16 million for an individual. That means if your total estate is less than that amount, your heirs won't owe any federal estate tax. But when that exemption gets slashed in half in 2026, dropping to around $7 million, a whole new group of families will suddenly find themselves in the crosshairs of the IRS. You might be thinking, $7 million is still a lot of money. My estate isn't worth that much. But you might be surprised. Your estate isn't just the cash you have in the bank. It's the value of your home, which for many people has appreciated significantly over the years. It's the full value of your traditional IRAs and 401ks. It includes life insurance, death benefits, even if they are paid directly to a beneficiary. It's any business or farm you own, your investment portfolio, art, collectibles, everything. When you add it all up, it's not that difficult to cross that new lower threshold. And if your estate does exceed the exemption amount, your heirs will be hit with a 40% tax on every dollar over that limit. And think about that for a second, a 40% tax. This often creates a massive liquidity problem. Most people don't have that kind of cash just sitting around. So what happens? Heirs are often forced to sell assets they wanted to keep. They might have to sell the family home, liquidate a stock portfolio at a bad time, or even sell a family business that took generations to build. This isn't just about money, it's about the legacy you intended to leave behind. It becomes, as Buffett rightly calls it, an act of wealth destruction. The value you worked your entire life to create is dismantled simply to pay a tax bill. Now, let's address the elephant in the room, Congress. It's easy to assume that lawmakers will see this cliff coming and pass legislation to extend the current lower tax rates. After all, nobody wants to be the politician who raised taxes on millions of retirees, but relying on that is a dangerous game. The political reality is that our government is more divided than ever. Major tax policy is intensely partisan, and finding common ground is incredibly difficult. Think about the timing. We have major election cycles coming up. The political focus will be on winning elections, not on crafting complex bipartisan tax legislation. Historically, these kinds of major decisions are put off until the 11th hour. Sometimes a deal is struck, and sometimes it isn't. Do you really want to bet your family's financial future on a last-minute political negotiation in a deeply polarized Washington? It's a gamble, not a plan. The prudent approach is to plan for the laws as they are written, and the law as it is written says these tax cuts are expiring. Hoping for a legislative miracle is not a sound financial strategy. This brings me to the most important point I want to make today: the critical importance of acting early. History has shown us time and time again that when it comes to major tax changes, the people who act before the deadline are the ones who come out ahead. Those who wait, who procrastinate, or who simply hope for the best almost always end up paying more, losing control, and facing a far more complicated situation. Inaction has a real cost. It means you'll likely pay more in taxes, both on your income during retirement and on the assets you leave to your heirs. It means you lose control over the timing of critical financial decisions. Instead of strategically managing your tax liability, you're forced to react to whatever new rules are in place. This can lead to reduced inheritances for your loved ones, and in the worst-case scenarios, the forced liquidation of assets that held deep personal or financial value. The window of opportunity we have right now between today and the end of 2025 is incredibly valuable. This is a unique period where we have certainty. We know what the tax rates are now, and we know they are scheduled to go up. This gives us the chance to be proactive. We can make moves today under the current favorable rules to protect ourselves from the less favorable rules that are coming. Think of it like a storm on the horizon. You can see the dark clouds gathering. You can either wait until the storm hits to start boarding up your windows, or you can prepare in advance while the sun is still shining. Preparing now gives you options. Waiting until the storm is overhead leaves you scrambling and exposed. Every month that passes is a month less you have to implement strategies that could save your family a significant amount of money and stress. The discomfort of tackling this now is temporary, but the damage from doing nothing could be permanent and profound. So what can you actually do? It's one thing to understand the problem, but it's another to know the solution. The good news is that there are powerful legal strategies you can use right now to shield your retirement from these coming tax hikes. These aren't loopholes or clever tricks. They are well-established financial planning tools that become incredibly effective in our current environment. Let's walk through some of the most important ones. The first and perhaps most powerful strategy for many retirees is the Roth conversion. You've likely heard of Roth IRAs, but you might not have considered converting your traditional IRA or 401k funds into one. Here's how it works. You take a portion or all of the money in your tax-deferred retirement account, like a traditional IRA, and move it into a Roth IRA. When you do this, you have to pay income tax on the amount you convert in the year you do the conversion. I know what you're thinking. Why would I want to voluntarily pay taxes now? The answer is simple. You're choosing to pay taxes at today's known lower rates rather than being forced to pay them at tomorrow's unknown, but likely higher rates. You are taking control of your tax bill. By converting now between today and the end of 2025, you are locking in the current 12%, 22%, or 24% brackets before they jump back up to 15%, 25%, and 28% or higher. It's a strategic trade-off. You accept the tax bill today to secure a tax-free future for that money. Once the money is in a Roth IRA, the benefits are immense. First, all future growth and withdrawals are 100% tax-free in retirement. That's a huge advantage. Imagine having a pot of money you can draw from without having to worry about what it will do to your tax situation each year. Second, Roth IRAs have no required minimum distributions, RMDs, for the original owner. This is a game changer. With a traditional IRA, you're forced to take money out starting at age 73, whether you need it or not, and every dollar you take out is taxable income. This forced income can push you into higher tax brackets and trigger taxes on your Social Security. A Roth IRA gives you back control. You can let your money continue to grow untouched for as long as you live. Finally, the money you leave to your heirs from a Roth IRA is generally received by them tax-free. This is an incredible gift to the next generation. Instead of inheriting a massive tax liability from a traditional IRA, they receive a source of wealth they can use without sending a huge chunk of it to the government. The timing for this strategy is absolutely critical. The years 2024 and 2025 represent a closing window of opportunity to execute Roth conversions at what may be the lowest tax rates you'll see for the rest of your life. The second key strategy is to take advantage of the current high estate tax exemption through gift. As we discussed, the exemption is set to be cut in half in 2026. This means you have a limited time to move significant assets out of your taxable estate, while the limit is still over $13 million per person. By making substantial gifts to your children or other heirs, now you can permanently remove those assets and all their future growth from your estate. For example, if you gift a block of stock worth $1 million today, you use up $1 million of your lifetime exemption. But if that stock grows to be worth $3 million over the next decade, you have effectively removed all $3 million from your future estate. This can save your heirs hundreds of thousands of dollars in potential estate taxes. This is a use it or lose it situation. The IRS has confirmed that they won't claw back large gifts made under the current high exemption levels. So if you use your exemption now, it's locked in even after the law changes. Of course, gifting needs to be done carefully. You must ensure you don't give away so much that you jeopardize your own financial security in retirement. This isn't about leaving yourself short. It's about strategically transferring wealth that you are certain you won't need. It also requires careful planning to navigate rules around things like the generation skipping transfer tax and to consider the tax basis of the assets you're gifting. This is an area where professional advice is absolutely essential to make sure you're doing it right. A third area to consider involves charitable strategies. If you are philanthropically inclined, there are several ways to support causes you care about while also improving your own tax situation. For retirees over age 70, HOF, the Qualified Charitable Distribution or QCD, is a fantastic tool. It allows you to donate up to $105,000 per year directly from your traditional IRA to a qualified charity. The amount you donate counts towards your RMD for the year, but it is excluded from your taxable income. This is better than taking the RMD, paying tax on it, and then taking a charitable deduction. By excluding the income entirely, you lower your adjusted gross income, which can help you avoid triggering taxes on Social Security or higher Medicare premiums. For larger estates or more complex situations, tools like donor-advised funds or charitable remainder trusts can be incredibly effective. These allow you to get a significant tax deduction up front while strategically planning how your charitable gifts will be distributed over time. These strategies not only fulfill your charitable goals, but can also shrink the size of your taxable estate, further protecting your assets from the 40% estate tax. By combining these strategies, you can create a plan that aligns with your values and significantly reduces your family's future tax burden. The key is to explore these options now while you have the time to implement them thoughtfully. Beyond those big three strategies, Roth conversions, gifting, and charitable planning, there are other more nuanced tactics you can employ to make your retirement finances more resilient to the coming tax changes. These might seem like smaller adjustments, but when combined, they can add up to significant savings over the long run. Let's call this the fine-tuning of your financial plan. One important area to focus on is creating a tax-efficient withdrawal strategy. Most retirees have money in three different types of accounts: tax-deferred like a traditional IRA or 401k, tax-free like a Roth IRA, and taxable like a regular brokerage account. The order in which you pull money from these accounts in retirement can have a massive impact on your annual tax bill. The common wisdom used to be to drain your taxable accounts first, then your tax-deferred, and save your tax-free Roth money for last. But in a rising tax environment, that may not be the best approach. Instead, a more dynamic strategy might be necessary. In some years, it might make sense to pull from your traditional IRA, but only up to the top of a certain tax bracket. Once you hit that ceiling, you could switch to taking withdrawals from your taxable brokerage account for the rest of your spending needs. In other years, especially if you have a large one-time expense, drawing from your tax-free Roth account could prevent that expense from pushing you into a much higher tax bracket. By strategically blending your withdrawals from these different accounts, you can help manage your taxable income each year, keeping it as low as possible. This is particularly crucial for staying below the thresholds that trigger taxes on Social Security or higher Medicare premiums. Having money in all three buckets gives you flexibility, and flexibility is one of the greatest assets you can have in an uncertain tax future. Another related idea is the timing of your income. While much of a retiree's income is fixed, like Social Security or a pension, other sources can be controlled. For instance, if you plan to sell a highly appreciated asset like a stock portfolio or a second home, doing so before 2026 could be highly advantageous. Capital gains tax rates are also scheduled to change. By selling now, you can lock in today's more favorable capital gains rates. Deferring that sale until after 2025 could mean paying a higher tax rate on the exact same transaction. You have a window to accelerate certain income events into these lower tax years, and defer deductions if possible into future higher tax years where they will be more valuable. It's about looking at the next few years as a whole and shifting income and expenses between them to minimize your total tax liability over the entire period. Now let's talk about a more advanced but incredibly powerful tool for estate planning: trusts. For many people, the word trust sounds like something reserved for the ultra-wealthy, but that's simply not true anymore. With the estate tax exemption dropping, more and more families can benefit from using trusts to protect their assets and ensure their wishes are carried out. A trust is essentially a legal entity that holds assets on behalf of a beneficiary. You, as the grantor, transfer assets into the trust, and a trustee you name manages them according to the rules you set out in the trust document. There are many different types of trusts, but one key function is to remove assets from your taxable estate. For example, an irrevocable life insurance trust, or ILIT, can be used to hold a life insurance policy. When you pass away, the death benefit is paid to the trust, not to your estate. The trust then distributes that cash to your beneficiaries, completely free of estate taxes. This can provide the instant liquidity your family might need to pay any other estate taxes or expenses without having to sell off other assets like the family home or business. Other types of trusts can be used to hold property, investments, or business interests. By moving these assets into a trust, you can effectively freeze their value for estate tax purposes, passing any future appreciation to your heirs without it being counted as part of your estate. Trusts also provide a level of control and protection that a simple will cannot. You can specify how and when your heirs receive their inheritance, protecting it from creditors, divorces, or their own poor financial decisions. It ensures your legacy is managed according to your values long after you're gone. Setting up a trust is a complex process that absolutely requires the guidance of an experienced estate planning attorney, but it is one of the most effective ways to shield a lifetime of work from the full impact of the estate tax. All of these strategies, tax-efficient withdrawals, income timing, and trusts, require a proactive mindset. They require you to stop thinking of taxes as something that just happens to you once a year and start seeing tax planning as an ongoing, integral part of your overall financial life. The system is changing, and the old set it and forget it approach to retirement planning is no longer sufficient. You have to be an active participant in managing your financial future. This isn't about being greedy or trying to avoid paying your fair share. It's about being smart, strategic, and using the rules that are available to everyone to protect the money you worked your entire life to save. Ignoring these tools is like leaving money on the table, money that could be used to enhance your retirement or secure your family's future. I understand that everything we've talked about can feel overwhelming. Dealing with taxes, estate planning, and trusts can seem complicated and frankly a little intimidating. There's a natural human tendency to put these things off. It forces us to confront our own mortality, have difficult conversations with family, and dive into financial details that can feel complex. It's much easier to just put it on the back burner and hope for the best. But as Warren Buffett often emphasizes, the temporary discomfort of planning now is nothing compared to the permanent damage that inaction can cause later. Procrastination is not a neutral act. In this case, it's an active choice that works directly against your financial interests. The math is not on the side of those who wait. Every day that passes, the window of opportunity to act under these historically low tax rates gets a little bit smaller. Let's zoom out and look at the bigger economic picture for a moment, because it reinforces the urgency of this situation. The United States is facing rising national debt and increasing mandatory spending obligations for programs like Social Security and Medicare. These are not political talking points, they are demographic and mathematical realities. To meet these obligations, the government really only has three choices: cut spending drastically, which is politically almost impossible, inflate the currency, which erodes the savings of every citizen, or raise taxes. The most likely path, historically and logically, is that taxes will have to go up over the long term. What does that mean for you? It means this current low tax environment we're in right now might just be the best it's ever going to get. The tax hikes scheduled for 2026 aren't just a temporary reversion to old rules. They might be the beginning of a new long-term trend of higher taxes for everyone. Waiting and hoping that taxes will go down in the future is betting against demographics, against government spending trends, and against basic arithmetic. It's a bet you are very likely to lose. And the consequences of losing that bet extend far beyond your own retirement. The failure to plan for these changes has a profound impact on generational wealth. The money lost to higher income taxes, the assets forcibly sold to pay a 40% estate tax, that is, wealth that is permanently removed from your family. It means a smaller inheritance for your children and grandchildren. It means they might start their own financial lives from a lower starting point with fewer resources to buy a home, start a business, or educate their own kids. The financial decisions you make or fail to make in the next year or two will create ripple effects that last for generations. Poor planning causes compounding, long-term damage to a family's financial security. So let's bring it all together. The central message is this: 2026 is a financial cliff, and retirees are standing right at the edge of it. The tax laws as they are currently written will change everything. Unless Congress acts, which is a risky bet, your income taxes will go up, your deductions will go down, and your estate could be subject to a massive tax bill. But you are not powerless. You have a shrinking but still viable window of time to take control of this situation. You have the tools available to build a defense around your life savings. You can plan based on the laws we have today, not on wishful thinking about what politicians might do tomorrow. Think about the strategies we've discussed. You can use Roth conversions to move your retirement savings from a forever taxed account to a never taxed again account, paying the taxes now at today's lower rates. You can use strategic gifting to take advantage of the high estate tax exemption before it gets cut in half, moving wealth to the next generation efficiently and effectively. You can leverage charitable planning to support causes you believe in while simultaneously reducing your income and estate tax burdens. You can use trust to protect your assets, provide for your heirs, and ensure your legacy is preserved according to your wishes. These are not just abstract ideas, they are concrete actions you can take to save money, preserve your wealth, and protect the financial future of your family. But they all require one thing: you have to start now. You still have time, but you don't have a lot of it. The clock is ticking towards January. Those who act in the coming months will be the ones who secure a more comfortable retirement, free from the anxiety of rising taxes. They will be the ones who pass on more of their hard-earned wealth to their loved ones. They will be the ones who look back on this period and feel the quiet satisfaction of having made smart, proactive choices. Those who wait, who get stuck in analysis paralysis, or simply hope the problem goes away, will inevitably pay more. They will lose options, lose control, and leave their families in a more difficult position. The choice is yours. You can be a passive observer of these changes, or you can be an active participant in shaping your own financial destiny. Please, for your own sake and for the sake of your family, don't let this opportunity pass you by. Take the first step today. Talk to your financial advisor, your accountant, your estate planning attorney, and start building your plan. Your future self will thank you for it.